In 2022, Mexico entered what economists call a technical recession. Its economy contracted 2 quarters in a row at the end of 2021. When the pandemic hit, it made everything worse. Informal workers, women, and youth were particularly affected. Poverty rates, regional inequalities, financial exclusion, and corruption kept the country's productivity low. Economic forecasts projected that Mexico's economy will face a high risk of recession due to an unexpected slowdown in the United States. They weren't completely right. The economy bounced back with 4.7% growth in 2021. But then real GDP growth was projected to reach 2.6% in 2023 and edge down to 2.1% in 2024 as it became clear that Mexico lost its momentum after 2021. Yes, it's done better than expected. Its growth was silently faster than anticipated as GDP rose an annualized 1.6% compared with median expectations of 1.2%. In the first half of 2023, Mexico's GDP grew 3.7%. Its wages went up, public spending increased, and it surpassed China to become the largest commercial partner of the United States. How did Mexico go from a technical recession to surprising economists with its growth? In this video, we'll look at the causes and effects of Mexico's technical recession in the past 2 years and how it has managed to bounce back from 2021 to 2023. First, let's understand what a technical recession means. A technical recession occurs when a country's economy contracts for 2 consecutive quarters. In simpler terms, the economy is shrinking, businesses are producing less, and people might be spending less. It's a concerning situation for every economy. For Mexico, the economy even shrunk 4 quarters in a row. When the pandemic hit in 2020, Mexico's economy shrank by 4.5% as the virus ravaged factories, businesses, and households. It was the greatest contraction since the 1994 tequila crisis. For people who don't know, the tequila crisis was one of South America's first major currency crises, following the Mexican government's sudden devaluation of the peso against the US dollar in December 1994. The Mexican peso almost collapsed as the government got close to defaulting on its national debt. This time, as COVID-19 hit, the economy slowed. Many workers lost their jobs and stopped paying employment taxes, and service and product industries suffered, like the rest of the world. Despite a bounce back of 4.7% in 2021, Mexico's economy entered a technical recession. The economy suffered due to continuing global supply chain issues. It struggled with weak domestic production capacity caused by the structural damage during the pandemic and the lack of mitigation policies to help restore the level of productive investment. With global trade disruptions and reduced demand for goods, Mexican industries, especially manufacturing, were struck. Many factories faced closures or reduced production, leading to job losses and decreased economic activity. Government measures to limit competition slowed private investment. Additionally, rising inflation rates impacted consumer spending. In 2023, the Mexican economy is amid a broad-based expansion. One of the key factors behind this growth is private consumption. In 2022, employment grew 3.6% by adding 750,000 jobs, ending at 4.3% compared with pre-pandemic levels. The employment rate reached 2.7%, the lowest since records started in 2005. Also, the Mexican government increased the minimum wage, leading to a rise in real wage income and a strong labor market. This rise in real wages encourages more consumption. Mexico's unexpected growth can also be attributed to increased public spending. The value of building construction projects in Mexico grew 6.7% in June 2023, reflecting the current administration's push to complete its vast infrastructure projects. Transportation and urbanization works grew 92% year over year. The Mayan Trains, a railway line that surrounds the Yucatan Peninsula and connects 5 states in the Mexican southeast, and the Isthmus Train, which runs from the Pacific Ocean to the Gulf of Mexico, show respectable growth. Oil and petrochemical works grew 20% yearly, showing the most growth among construction works. The economy recovered both its employment and gross domestic product to pre-pandemic levels. Another factor that has helped Mexico recover from the pandemic is a phenomenon called nearshoring. This is when a company moves all or part of its production closer to the final consumer, reducing costs and avoiding logistical setbacks. Due to supply chain issues and the Russian-Ukraine war, businesses worldwide started looking for alternatives in the last few years. Mexico is one of the alternative countries to benefit from nearshoring. The construction of industrial facilities in the country has grown 19% in the first 6 months of 2023 compared to last year. According to Deloitte, it has finally exceeded the highest level reached in 2017. Productivity in Mexico, which has remained practically unchanged since 2005, is changing in the manufacturing sector. Productivity grew 4% in 2022 compared to 2021 and is now 10% above 2005. Investment in machinery and equipment is growing in a manner not seen since 2011. In the first half of 2023, it grew 20% compared to last year. The US-Mexico-Canada trade agreement also increased regional value content requirements for products to be considered to be made in North America, giving producers an incentive to relocate their supply chains. This has served as another incentive to relocate to Mexico. By setting up factories within Mexican borders, manufacturers can stick a Made in Mexico label on their products and pay zero duty on many products. Who wouldn't want that? According to Deloitte, nearshoring can help Mexico add 3% to its GDP in the next 5 years. Already, it has helped the nation recover its business confidence and private investment. The relocation of manufacturing plants to Mexico led to foreign investment, new and specialized jobs, expansion of manufacturing activities, and a boost in productivity. In fact, foreign direct investment registered was up to $29,041 million in the first half of 2023. At the same time, foreign-owned debt has increased. Long-term government securities make up 82% of foreign-owned Mexican public debt. The extent of non-resident government debt holdings is a testament to Mexico's exposure to international investors and a sign of confidence in the Mexican economy. The United States, which shares an excellent first half with Mexico, is also helping the nation through trade and remittances. For the first time in 20 years, Mexico became the largest commercial partner of the United States since 2022. Remittance flows to Mexico slowed at the beginning of 2022 due to high inflation in the US and elsewhere, which reduced disposable income. However, remittances to Mexico bounced back in May 2023 and have been going upward since then. Let's not forget how the Mexican peso enormously appreciated in the second half of 2022. It sits at 18.16 to a dollar as of October 8, 2023. Although the peso has been under pressure due to high inflation and increased uncertainty regarding domestic and global growth, it has remained relatively stable over the last 2 years. Mexico's central bank made the right call when it aggressively raised domestic interest rates in anticipation of and response to U.S. interest rate hikes and stubbornly high inflation. The central bank estimates inflation could drop to the target rate of 3% by the third quarter of 2024, after rising to an expected 8.1% in 2022 and lowering to 4.2% in 2023. Although over the last 3 decades, Mexico has underperformed in growth, inclusion, and poverty reduction compared to similar countries and has lost momentum since its rapid growth in 2022, there's hope for the country still. Mexico isn't the second largest economy in Latin America for no reason. The historically rich country of 130 million people has solid macroeconomic institutions, is open to trade, and has a diversified manufacturing base connected to global value chains. Mexico has almost consistently exceeded expectations post- and pre-pandemic. However, it must address structural constraints. Limited access to finance, insecurity, informality, regulatory burdens, and low infrastructure are challenges plaguing Mexico and its people. Tackling these challenges is essential to fully seize the opportunity that nearshoring represents in the current international environment. Mexico still needs to invest more in public infrastructure, working capital, new technologies, and public policies. In the meantime, the economy remains resilient as it catches up to the rest of the world and surpasses many. That brings us to the end of this video. If you found it insightful, like and subscribe for more informative content. Leave a comment if there's a topic you want us to make a video about. We would love to create one especially for you. Just let us know in the comments. See you in our next video.